Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to share with you today might be the most important financial story of 2026. Jerome Powell is gone, and the man who just replaced him is about to do something that has never been attempted in the history of the Federal Reserve. Not once, not ever. Kevin Warsh officially took over as Federal Reserve Chair on May 15, 2026. And his plan for the money system? It would reset the fundamental plumbing of how money moves through the entire American economy. The Fed's balance sheet currently holds $6.7 trillion in assets. Before the 2008 financial crisis, that number was just $900 billion. That's more than 7 times the pre-crisis level, built up through years of money creation that Warsh has been criticizing ever since. And now he wants to shrink that balance sheet aggressively through quantitative tightening, while cutting interest rates at the exact same time. That specific combination, QT while cutting rates, has never been done before in the modern history of central banking. If you're serious about understanding what this means for your money, your mortgage, your 401k, your savings account, hit that subscribe button right now. Because this story affects every single financial decision Americans are going to make for the next several years. Let's get into it. To understand what Warsh is planning, you first need to understand who he actually is. Because he's not a typical central banker. He's not a career academic economist. He's something the Fed hasn't seen before at the top. Kevin Warsh is a former Morgan Stanley investment banker and Harvard Law graduate. He served as a Federal Reserve governor from 2006 to 2011, meaning he was inside the Fed during the 2008 financial crisis itself. He watched Ben Bernanke launch the first quantitative easing program in history, and he formed very specific views about where that decision ultimately led America. After leaving the Fed in 2011, Warsh joined Stanford's Hoover Institution. There, he spent years developing his critique of the Fed's post-crisis framework. He was considered for Fed chair in 2017 before Trump chose Powell instead. Now, 9 years later, Warsh finally holds the position he was denied. His Senate confirmation was 54 to 45, the closest vote for a Fed chair in the modern era, almost completely along party lines. That tells you everything about how divisive this appointment really is. When you see a margin that thin on something this consequential, pay attention. So what is the plan exactly? Warsh calls it, and markets are calling it, QT for cuts. And to understand why it's never been tried before, you need to understand what each piece does on its own. Quantitative tightening, QT, means the Fed is actively selling assets it owns. When the Fed sells assets, money flows out of the financial system. That removal of money tightens financial conditions and makes borrowing more expensive across the entire economy. Quantitative easing, QE, did the exact opposite. The Fed bought assets, pumping money into the system. That QE policy is precisely what built the $6.7 trillion balance sheet we have today. Now here's where it gets interesting and where it gets dangerous. Rate cuts loosen financial conditions. They make borrowing cheaper for consumers and businesses. QT tightens financial conditions. It removes money from the system and makes borrowing harder. Doing both at once creates deliberate, calibrated tension inside financial markets. And Warsh believes that tension is precisely what the money system needs right now. Warsh's core argument is simple but radical. The $6.7 trillion balance sheet is the structural problem. He believes the oversized balance sheet keeps underlying inflation persistently too elevated. The way to fix it is aggressive quantitative tightening. But cutting rates is also needed because recession signals are flashing everywhere. J.P. Morgan raised its U.S. recession probability to 60% by April 2026. Goldman Sachs simultaneously raised its own estimate to 45%. Those numbers tell Warsh the economy needs rate relief, but cutting rates alone, without addressing the balance sheet, risks reigniting inflation. Now let's look at the inflation backdrop Warsh just inherited. because the numbers complicate his rate-cutting plans in a significant way. April 2026 CPI came in at 3.8% year-over-year, confirmed by the Bureau of Labor Statistics. That's the highest reading since May 2023. Before the U.S.-Israeli strikes on Iran in late February, inflation had eased all the way down to 2.4%. Energy prices have since surged, pushing CPI sharply higher. And then came the PPI. Producer prices rose 6% year-over-year in April, the largest 12-month increase since December 2022. Producer prices lead consumer prices. What businesses pay today, consumers pay tomorrow. This is the precise dilemma that makes Warsh's approach so unprecedented. The economy is showing recession signals that scream for rate cuts, but inflation is running at 3.8%, almost double the Fed's 2% target. And producer prices are telling us consumer inflation hasn't peaked yet. Most economists would say you can't do both at once. Warsh is saying, watch me. Now here's the part that keeps bond market analysts up at night. The historical comparison that best contextualizes Warsh's challenge is Paul Volcker in 1979. Volcker inherited entrenched inflation and solved it by hiking rates to 20%, triggering a deep recession. Warsh cannot do that. And the reason is sitting right there on the U.S. Treasury's website. The U.S. national debt is now approximately $39 trillion. Moody's, which downgraded the U.S. credit rating in May 2025, projects federal debt reaching 134% of GDP by 2035, compared to 98% in 2024. Interest payments on this debt are projected to exceed $1.8 trillion annually by 2035, more than current spending on defense, education, and transportation combined. At $39 trillion in debt, hiking rates to Volcker levels would cost the U.S. government more in interest than it collects in taxes. The Volcker solution is off the table. QT for cuts is Warsh's answer to a problem that has no easy solution. Let's make this real, because Warsh's reset isn't abstract. It has a very specific impact on 4 types of Americans. Let's go through each one. Homebuyers. QT creates upward pressure on Treasury yields, which directly drives mortgage rates higher. Rate cuts would offset some of that, but not necessarily all. The core paradox. Rate cuts should lower mortgage rates, but aggressive QT could keep them elevated regardless. Housing affordability in 2026 is already at its worst level in over 40 years. Watch actual mortgage rates, not just the Fed headline decision. Savings holders. High-yield savings accounts were paying 4 to 5% APY in 2026. If Warsh cuts rates, those yields come down quickly. Locking in rates now makes strategic sense. 401k investors. QT applies persistent downward pressure on equity valuations. When money leaves the system, stock valuations compress. The S&P 500 has historically shown sensitivity to Fed balance sheet changes. Rate cuts would partially counterbalance that, but the net impact depends on calibration and timing. Diversify across rate scenarios. Don't position for one single outcome. Fixed income investors. More QT means more bond supply entering the market. More supply drops prices and lifts yields on new bonds. Higher yields eventually help savers, but hurt current bondholders. Every major asset class faces a different, sometimes contradictory impact from QT for cuts. The date every financial institution in the world has circled is June 16, 2026. That's Warsh's first FOMC meeting as chair. And what every analyst wants to know isn't just the rate decision, it's how aggressively Warsh plans to run the balance sheet reduction. That's what sets the tone for everything else. The CME FedWatch tool currently shows 98% probability of no rate cut at that meeting. But the bigger signal isn't the rate decision. It's the QT announcement that follows. 3 things every American household should do right now. First, do not assume the current high-yield savings environment continues. If Warsh cuts rates, those APY yields drop quickly. Second, watch actual 30-year mortgage rates, not just the headline FOMC decision. They can diverge significantly under QT for cuts. Third, diversify your portfolio across rate scenarios, not just one outcome. Warsh's uncertainty demands positioning that doesn't assume one single direction. This is the most consequential monetary transition in modern American financial history. Powell managed the existing framework. Warsh wants to replace the framework itself, and whatever he announces on June 16th will set the direction of every American household's financial reality for years to come. Investing isn't about predicting the future with certainty. It's about understanding the forces at play and positioning yourself for multiple outcomes. That's what separates serious investors from people who just react. Before you go, do 3 things. First, smash that like button. This kind of analysis takes real work and it genuinely helps the channel grow. Second, subscribe and hit the notification bell, because when June 16th arrives, you need to be in the room. And third, drop a comment. Do you think Warsh's QT for cuts plan is monetary genius, or the most dangerous gamble in Fed history? I'm Alex Carter, and I'll see you in the next one.